What if I told you that 12 essential company metrics can instantly tell you whether a stock is a good investment or a ticking time bomb? But before I list the 12 essential company metrics, here's some important rules to follow. Rule number 1, context or nothing. One number alone means nothing. Context is everything. If I tell you a stock has a P/E ratio of 15, that information alone is useless. Every metric must be viewed over time, compared to competitors within the same industry. Comparing a bank to a tech company? That's like comparing a bicycle to a rocket. And rule number 2, never invest in a business you don't understand. Read the reports. Understand how it makes money. Otherwise, you're buying a mystery box. Now, here are 12 essential company metrics that professionals use to value stocks and businesses. First, profitability. Check the company's revenue growth. Revenue is total sales, but growth tells the real story. A smaller company growing fast can be far more attractive than a giant that's shrinking. Next, EBITDA margin. EBITDA is the profit a company makes before interest, taxes, and accounting tricks. Think of it like this. How much money is left after running the business before the financial games? Higher margin equals stronger core business. Return on equity, ROE metric, shows how efficiently a company uses shareholder money. High ROE equals shareholders are being rewarded. But be careful, profits can be manipulated. Cash is harder to fake. Next important metric, financial stability. The equity ratio. How much of the company is owned versus borrowed? Below 25%? That's risky territory. More equity equals more stability. Check the gearing, net debt to equity metric. This tells you how leveraged the company really is. Low gearing equals safer. Too high equals one crisis away from disaster. Negative gearing means the company has more cash than debt, not always good either. Valuation metrics, market capitalization, stock price times, number of shares. This is what the market thinks the company is worth, but it's not the full story. Next, enterprise value, EV. This is the real price tag. EV equals market cap plus debt minus cash. If you bought the entire company tomorrow, this is what you'd actually pay. EV to revenue metric. Great for companies with low or no profits. If investors pay 0.5 times revenue for one company and 0.8 times for another, the second is considered more valuable. EV to EBITDA, one of the most used professional metrics. It compares businesses after costs, not just sales. Lower usually means cheaper compared to competitors. P/E ratio, price to earnings, the famous one. How many years of profit you're paying for today. But profits can be manipulated, so always look at this over many years. Price to book, PB, market value versus balance sheet value. Below one, you're buying assets cheaper than their accounting value. Rare and sometimes risky, but interesting. Price to cash flow. Cash flow is king. Harder to manipulate than profit, but more volatile. This ratio shows how many times investors are paying for real money coming in. That was a lot, I know. But now, when you see stock metrics on a broker app, they won't look like random numbers anymore. These 12 metrics won't replace deep analysis, but they are a powerful first filter. If you want deeper breakdowns, balance sheets, income statements, real company examples, drop a comment below. Like the video if it helped. Subscribe for smarter investing, and I'll see you in the next one.